How do presidential elections impact the stock market? In today's video, we are going to be talking about the market's recent performance after the election, and we are going to discuss, can people predict what the market is going to do ahead of or after a presidential election? And if not, what is an important number that we can focus on as long-term investors? So in the last week after the presidential election, the S&P 500 has gone up around 5%. And the Russell 2000, which for those who don't know, the Russell 2000 is a publicly traded index of 2,000 U.S. smaller companies. So the S&P 500 is larger companies, Russell 2000 is smaller companies. Well, while the S&P 500 went up around 5% during the last week, the Russell 2000 went up 10% over the last week. And so that then begs the question, did anyone predict this? Did we hear any pundits on the media? Did we read any papers talking about, well, we think if so-and-so gets elected, in this case it was Donald Trump gets elected, we think the S&P is going to go up around 5%, and we think the Russell 2000 is going to go up double what the S&P 500 does. And I will give you the short answer is no. I did not hear, of all the predictions that were out there, I did not hear this prediction once, which was a large jump in the S&P 500 and an even larger jump in smaller companies. And a good acid test, and the reason that we know this wasn't predicted publicly, is if this were predicted publicly, this person would be all over the news as a fortune teller. And unfortunately, it didn't happen, or fortunately, we don't really know. But, okay, so we know that no one accurately predicted who's going to get elected and then how the market is going to react. So if we can't predict that, and we can't link those two, then what is a more important number that we can focus on as long-term investors? So let's bring up both of those charts, the S&P 500, the Russell 2000. One was up 5, one was up 10. So pretty good weeks for both. But what might be another reason why the Russell 2000 had such a great week relative to the S&P 500? And let's move away from the squiggly line and go to some of these numbers in the boxes below. And if you'll look at this box here, the price to earnings ratio. I have spent many videos discussing this ratio, which is essentially what are people willing to pay for $1 of earnings of this company, or in this case, this index. And for the S&P 500, people are willing to pay about $30 for every dollar in earnings in the S&P 500. And in the Russell, it's about half that. People are willing to pay about $15 per dollar in earnings for smaller companies in the United States. Now, you might be looking at that and saying, well, Kyle, I have no context. Is this normal? Is it abnormal? And I will just tell you, you can look back at prior videos, we've discussed this more in detail, but the S&P 500 is currently quite a bit more expensive than it is historically. The Russell 2000, the smaller companies in the United States, is quite a bit cheaper than it is historically. And if you have a combination of one investment that's pretty expensive and one investment that's pretty cheap, you might see periods where there's a big gap in performance. And this is what we saw over the last week. Now, more importantly is these are the price to earnings ratios after the recent outperformance. So smaller companies are still substantially less expensive per dollar in earnings than the S&P 500. Now, this is not investment advice. This is not saying this is going to continue next week or even next year. But what this is talking about is two things. One, nobody can predict what's going to happen in the market based on what's happening in the news or the media or politics. The other is, as long-term investors, we can ignore the short-term news and focus on true fundamentals of these companies like the price to earnings ratio so that we can make better long-term decisions. Hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.